it's departing to get worse. Rising prices are here to linger. Commodities are departing to boom. Oil charges are departing to soar. Bonds are departing to crash. And gold has been in a very amusing position, which is the following. Normally you speak, well, if it's rising prices future, why isn't the charge of gold departing to the moon? And why on earth would gold charges go up if there were deflation or disinflation in it? The answer is that you have to gaze at the yield of maturity on the 10-year Treasury note. That's our benchmark security. A lot of people gaze at LIBOR, but I'm like, no. If you're making investment decisions, you're buying a house, you're doing capital investing. These are all 510, sometimes 20-year decisions. The 10-year note is the right benchmark for those large long-term investments. That's an alternative place to put money. You can buy gold, you can buy a 10-year Treasury note. So what's been true since last summer is as the yield of maturity on the 10-year note goes up, that strengthens the dollar, and gold charges have gone down because the dollar charge of gold is just another cross rate, just another cross exchange rate. So a stronger dollar means a lower dollar charge for gold. But if the yield of maturity in the 10-year note goes down, then that weakens the dollar and the dollar charge of gold goes up. Because a weaker dollar means a higher dollar charge for gold. So, curiously, the charge of gold is being driven not by rising prices in the abstract, but by the strength of the dollar, which is reciprocal to the interest rate on the 10-year Treasury notes. But here's what has changed. I talk about gold bull markets and gold bear markets, and I start my analysis in 1971, and I don't have to go through all that data, but that's how I think about it. And you're like, well, Jim, why 1971? Why not before that? And of course, 1971 it was, when Nixon stopped redeeming dollars for gold. Americans couldn't even own gold in 1971. It was controversial. It was like drugs or machine guns or something, but foreign trading partners could redeem dollars for gold up until 1971. And then Nixon said, no more. And then that was the final decoupling. But prior to that, gold was actually money. In other words, under Bretton Woods, gold was pegged at $35 an ounce. Prior to Bretton Woods, it was pegged at $20.67 an ounce. Going back to the 1920s, earlier through most of the 19th century for the United States. And sterling, I think it was 475. It could be off a little bit on that, but £4 and change. And as late as World War I, speak 1913, if you were a Brit and you were getting on the steamer from London to, at the time, Bombay, today, Mumbai, you took a purse of British sovereigns. British sovereign is about 8 grams, a little bit less. It's not an ounce, it's quarter ounce, because an ounce is almost too much even today. What are you going to do with a 1-ounce coin? It's worth almost $2,000. You're not going to use that to buy a pack of gum. But in the day, there was the quarter ounce, which today would be like a $500 bill. It's still a significant amount of money, but you could get on the steamer in Southampton and get off in Bombay at the time, and it was money good. You could take that British sovereign and spend it anywhere. And same thing in Singapore and Hong Kong and Japan or all around the world. So gold was actually money. So it wasn't a question of, oh, what's the exchange rate? The gold was the money, and people thought about it by weight. They said, oh, a sovereign, that's 8 grams of gold, so that'll get you whatever. And that was true throughout history. And so it's really only since 1971, when we decoupled completely in terms of an exchange rate, that you have to think about what's the dollar charge of gold, because it's not fixed. But okay, well, what happened to the memory? What happened to the 3,000 years I just talked about? Well, the answer is it happened in stages, and it took about 75 years. Again in 1914. 1914 was the outbreak of World War I. Everybody needed gold. There was a run on gold, and countries needed gold because they knew they would need gold to pay for the war, to try to win the war. Whether it didn't matter if you're Germany, UK, or whoever. Remember, the United States was neutral. The United States did not get in the war until 1917. The war started in 1914. So for those first 2.5 years, New York was a money center to all Europe, to all the belligerents. So everyone scrambled for gold. So if you were a citizen, they asked you to bring your gold to the bank and they gave you paper money. But people did it out of a patriotic. It's existential war is not a normal market. If you lose the war, you got bigger problems than your gold. And so people put the gold in the banks. What did the banks do? They melted it down and made 400-ounce bars. And they said, don't worry, your money's backed by the gold. They keep using that paper money, but it's redeemable for gold. But, oh, by the way, they're 400-ounce bars. Nobody walks around with a 400-ounce bar in her purse. I'm sure you've seen one, and I have as well. They're heavy. They weigh about 35 pounds. You don't walk around with them. So all of a sudden, the gold was still there, and the paper money was backed by gold in theory, but the gold had disappeared into the banks. That's step one. Step two. And this happened in the 1930s. The central banks took the gold from the commercial banks. At first, the commercial banks took the gold from the people. Then the central banks took the gold from the commercial banks, and the Federal Reserve System told all the banks, hey, send your gold to the regional Federal Reserve Bank. Of course, most of it went to the Federal Reserve Bank in New York, so now it's not even in the banks anymore, right? But you're still walking around thinking your paper money is somehow attached to gold. But people haven't seen gold for a while, unless you're a collector. Step three, the United States Treasury and the finance ministries took it from the central bank. The United States Treasury seized the gold of the Federal Reserve System. Bearing in mind the Federal Reserve System is privately owned, and they gave them a gold certificate. And you go to the Federal Reserve System website today and hunt around a little bit on the links and find the balance sheet of the Federal Reserve, and it's there. And gaze at the assets. And the first line item is gold certificate. And it's valued at $11 billion. But that's because they value the gold of $42 an ounce. And I've revalued it.